something that helps develop hypotheses, right? So sorry, this is the outline first. This is what we're going to do today. So we'll start by talking about the role of the theory, and then we'll do these other things. Talk a little bit about double entry bookkeeping, because you sort of have to start there with accounting, but it's not going to be information economics yet. And then we'll do information economics. And a little discussion of earnings management at the end, right? So some predictive, or a lot of theorists for many years have been happy to say, well, I can help explain something that seems puzzling, right? So we're often looking for something of a surprise, right? We're using formal modeling in part to be precise with language, to be able to write out in a way that you can follow the argument and see any flaws in the argument. That's really the role of math, right? There's no reason the theory has to be mathematical, unless probably you're doing structural where you need the quantitative predictions. But generally, when I write theory, what I'm writing it for, the reason I'm writing it out formally is just so you can follow the argument carefully. If I did that in words, you might get lost here or there. So that's the traditional role. But actually in accounting, like most business school disciplines, that's not where we started, right? Most of the theory that was done in the 50s, say, or before that, was more normative in nature, right? So it was either, everybody's favorite theory of, what accounting should look like. Chambers had a view, and Giri had a view, and actually theirs was sort of on the borderline between positive and normative. But if you go earlier to Peyton, William Peyton, or Sweeney or others, they had sort of, their idea of what accounting should be, some argument about why it should be that way, but everybody had their own theory. The revolution in business schools, and some of that happened at Carnegie Mellon long before I was at Carnegie Mellon, where I spent 25 years, where Bill Cooper and Herb Simon and Lee Bach were the three original faculty members at the business school. They were really, particularly Bill Cooper, was devoted to solving real problems. And he would make statements that scared me to death, like, he never took a consulting engagement if he knew how to solve the problem. That he thought of every consulting engagement as either something to outsource to somebody else, if it was something that he already knew how to solve, or he would take it with the mind that he was going to, develop some new methodology. So he developed lots of extensions of linear programming. At the time, Lee Bach, the dean, used to ask him, have you gotten anybody to use linear programming? And he would say, no, no, no. And then finally it took off, right? And this sense of, they were really after real problems. Now you can say that when it comes to, the methods he was using, and he worked with Abraham Charnes, who was a mathematician at CMU, that they were really more operations research kind of problems. So that, field lends itself perhaps more to solving real problems than economics or social science in general. But there definitely was a lot of formal theory that made a lot of progress in solving real problems. And over time, we've had this sort of revolution in the 60s where we said, oh no, we're going to do positive accounting theory. We're not going to do normative accounting theory. And I think we've lost something with that, right? That we're not, we've become more divorced from practice. Auditors are less interested in what we have to say, and other accountants. And so there's, some room to think more about doing normative theory. The important point I want to make is you should think about what you're doing when you're doing theory. What kind of theory is it? Do you intend it to be positive? Do you intend it to be normative? And there's a third category, the way I think of it at least, which is more foundational research. Okay? So what does foundational research mean? Well, you could say it's an excuse for exploration. I just want to see where this leads. I'm kind of trying to understand the language around a problem or the mathematical structure of a problem, but I'm not really trying to come up with predictions. Another thing you can think of it is giving you benchmarks. So if I think of Miller-Modigliani's dividend irrelevance theory, what does that tell you? It tells you when dividends don't matter. If we believe dividends do matter, then we know that one of the assumptions they've made must be violated. So it gives us a framework to think about why dividends will matter by looking to violations of the assumptions. So it's an organizing principle, if you will, right? And so that's another way to think about foundational theories. And classification language, right? And then kind of everything else, right? It could be exploratory, it could be an analogy. And my colleague for many years believed very much in the power of analogy. So when he was a student studying accounting at a junior university in Japan with what turned out to be his father-in-law. At the time, it wasn't his father-in-law, but it became his father-in-law. They had him read a book called, translates from Latin to English as Tailor Retailer. And it was all about clothes and tailoring, but it was an accounting class. And so for a while, this really mystified Yuji, at least he claims it confused him. But then he realized the professor was trying to get them to see the connection between accounting and clothes, that accounting sort of gives you this visible outward appearance that everybody sees, and they really make the man, if you will, or woman, and that, you know, this sense of, you know, clothes and accounting being connected to sort of try to search for that analogy between different things. And he did a lot of work that, you know, explored connections between physics and accounting, including extending double entry bookkeeping to triple entry bookkeeping. He wasn't the first one to think about triple entry bookkeeping, but the first one to do it in a logical way where, you know, if you think that double entry gives you the connection between the balance sheet and the income statement, then there ought to be something like a momentum statement that looks at changes in income to get you to a third journal entry. So let's talk a little bit about double entry bookkeeping. Well, so Lee says that the oldest surviving records that he found are from Florentine banks in the 13th century. Usually we talk about Pacioli in 1494, but, you know, even this 13th century date, some people argue their records a little bit earlier than that, or at least of partial double entry bookkeeping. Then supposedly it had spread northward to Germany, Holland, and England, but wasn't really widespread outside of Italy until the 17th or 18th century, and took off in the 19th century. Right? So of course one thing to sort of naturally as a theorist to think, you know, what changed? What was it that happened during that time period? What changed in business? Double entry bookkeeping, as simple as it is, has some rather lofty admirers, right? Goethe in Wilhelm Meister's, I think it's the Wanderjahre, the travels, the wandering years of Wilhelm Meister, says, what advantage does he derive from the system of bookkeeping by double entry? It's among the finest inventions of the human mind, really? Double entry bookkeeping? For those of you that don't know German literature, Goethe is, you know, the name in German literature, sort of the classic writer Faust. The best version of Faust is Goethe's Faust. Someone pointed out, though, I think maybe anyway, somebody at a panel I was at pointed out that the character that says this is not the sharpest character in the book. So Yuji like this, you can imagine with the connection with clothes from Faust. He said, in the floods of life and creative storm, to and fro I wave, weave eternally and birth and grave an eternal sea, a changeful strife, a glowing life, at the roaring loom of ages I plod, and fashion the life-giving garment of God, right? So there's a spirit that's creating a garment that gave life to God. That's pretty ambitious, right? So you like that, again, thinking of accounting as creating that garment. Sir Arthur Cayley, who was one of the inventors of modern algebra, wrote a little monograph on double entry bookkeeping. It's actually not that interesting to read, but he's certainly somebody with incredible intellectual power, says that double entry bookkeeping is one of the two perfect sciences. My dad actually found this this picture in a bunch of his old photos from my grandmother, and it's Cayley, and he loved it because he was working on Cayley graphs. My father was a mathematician, but I'm sure she had it. In fact, it was from my great-grandfather who was an accounting professor, so somehow he was interested enough that somebody had given him a photograph of Cayley, or maybe they'd met.
What was the second?
Sorry? The second was Euclid's theory of ratios. There's another line which I like to leave out, which says, it's just too bad it's so simple. Otherwise, it would have been more interesting if there was more complexity to it. Something like that. Okay, so Jones, writing about double entry bookkeeping, says, look, we can think of this as sort of a duality, right? That if we look at, we can look at it from a balance sheet perspective, or we can look at changes, the gains and losses in the period to get a sense of where we are. So there's basically the income statement perspective and the balance sheet perspective and the way they're connected together, the duality between income measurement by looking at changes in the balance sheet and the income statement itself. My great-grandfather liked to use colorful language, so this was his take on it. Sired by a monk, damned by thousands of university students ever since. That's the talk, which is a fun talk to read, very entertaining. And he argues that it's the sort of the defense of double entry bookkeeping is based on its parentage and lineage. So he talks about the company one keeps, namely here he's talking about Pacioli and other mathematicians, services one renders to the community, and then he talks about why it sort of took off. In part, the new significance of accounting is due to the subdivision of ownership and the severance of ownership and control. So characteristic of the corporate form of business, the use of fixed capital on a large scale. So we need depreciation charges, right? Things like that really give rise to the importance of periodic performance measurement, right? So that's sort of at the heart, if you will, of double entry. An economic historian says capitalism without double entry bookkeeping is simply inconceivable. They hold together as form and matter. Anyone may indeed doubt whether capitalism is as procured in double entry bookkeeping a tool which activates its forces, or whether double entry bookkeeping has first given rise to capitalism out of its own spirit. Right? Pretty bold claim. Now, maybe too strong, but certainly it's intriguing, provocative. Littleton, who's probably, if you know history, think of Peyton and Littleton as sort of the Bible in accounting that lays out the case for historical cost accounting. But he was also a very influential and probably the one who tilted the monograph toward historical cost. Peyton was always more focused on what we think of today as fair value. That reservation of surplus appeared only after conservatism became a virtue in corporate finance. So some notion of the distinction between capital or retained earnings and income, so the equity and income not being sort of mingled together, but some separation, some sense of preservation of the company by preserving capital. That was an important part of double entry. And then Yuji says, it's not about having two ways to classify things, it's the causal link between the two, right? So in accounting, we can't say cash went up, we have to say why cash went up. So I could have a list that organizes you all by your gender. I don't know if it's 2 columns, 3 columns, or 20 columns, whatever we need. But in another way of organizing you based on, I don't know, age or IQ or whatever, that's not particularly interesting. There's no link between those two classifications. It's really the link in the language, the causal link, the way that the entries are connected to each other that inherently makes double entry bookkeeping what it is. And he argues that historical cost is inherently tied to double entry bookkeeping. So let's think about the mathematical structure. What is double entry bookkeeping? So suppose I've got the following transactions. Actually, those aren't transactions. What are those? Changes in balance sheets, right? So I've got a beginning balance sheet, an ending balance sheet, and changes during the period. Okay? And typical kind of exercise might be here are balance sheets. Here's some sorry, not just balance sheet accounts. I've given you also the income statement accounts for the period, right? Sales and wage expense. So you're given an income statement for the period and a beginning and ending balance sheet, and you're asked in a typical intro to accounting class to prepare a statement of cash flows using the indirect method. So to work backwards from the financial statements to the transactions, right? To think about what the underlying transactions are. And as you know, for those of you that have done this, there's some inability to completely invert back to the transactions because accounting aggregates, right? There's some information lost in the aggregation process. So if I think about what's happened, what the accounting does, double entry bookkeeping, what I've got is a particular transaction vector I look at for the period. And usually we start by assuming that all sales are credit sales, that you don't have any cash sales, right? Because we can't distinguish between cash sales and cash collections of credit sales. So we can just plug it through as if they're all credit sales, and then we'll see what gets collected. And the same thing with, say, wages in this example, right? We'll look at all wage expense as if it was done on accrual wages payable, and then the cash flow occurred later. Just make that simplifying assumption. So if I write that down that way, right, I can go through and mechanically say, well, the beginning balance plus credit sales minus the ending balance gives me cash collections of 180. So I figure out that the cash flow from customers was 180. And I can do a similar one with wages and say the wages paid were 120. And I can't differentiate between cash, as I said, cash sales and cash wages, right? I can't figure out. There could have been some of that. I've assumed it away, but I can't figure out that separation between those two because of the aggregation in the financial statements. So what's this? This is the matrix that converts the transactions into changes in balances, right? So I'll multiply, what are each of these columns? Transactions, right? What's the first transaction? It says you have a cash increase and an accounts receivable decrease. That's a cash collection, right, from receivables. So that's one double entry, right? So you get this 1 and -1 representing the double entry. Second column, well, you've got a cash sale, right? So we see credits have the negative sign, debits have the positive sign. It's just an incidence matrix that always has that feature that every column is going to have one positive one and one negative one. So that's one representation. So all we're saying is mathematically we can represent double entry bookkeeping as this incidence matrix that's going to aggregate transactions into financial statements. And that, what we know from linear algebra, can maybe help us understand the aggregation process. Okay, and so I can go back to the solution you came up with from your homework problem without having to know any linear algebra and plug it in, right? And verify that when I multiply it by A, I get out the change in financial statements. And I can think of it as a graph too, right? So what I've done here is just thought about the way these accounts can be connected, right? I can have a cash sale, which we've assumed was 0. Y2 was 0, right? And if I write an incidence matrix down this way, you see something, you see loops, right? You see two independent loops. You can go around from cash to sales to accounts receivable and back to cash, right? So you go backwards on Y2, which we'll indicate with a -1. You go forwards on the next one. I don't know if this works. And then forwards on this one. So I'd see a -1 weight on Y2, a 1 on Y3, and a Y on Y1. That loop tells you about information lost in the system. It's part of the null space in linear algebra. So it's telling us that you're going to lose information via that loop, if you will. That basically, we're not going to be able to figure out the difference between cash sales and cash that was collected on a credit sale. Okay. So I can look at our particular solution and say any two particular solutions, YP and YP prime, are related to each other via the null space loops. So basically I can add in these other transactions that won't affect anything in terms of the ending financial statements, put arbitrary weights on them as long as I don't have negative transactions, and any other solution that fits this will work as well. So for example, I can express I can say that maybe we had $20 in cash sales. Maybe we had $10 of cash wage expense. That's what those loops are going to give us. And I can write down my other solution, which has now credit sales not of, what did we start with, 180. It's reduced the credit sales to 160, but now we've got cash sales of 20. Okay? This is the kind of thing people did in the 1960s, right? 1960s and into the 1970s. They wanted to understand, connections between math and accounting. This seems like a starting place, right? Try to understand the mathematical structure of double entry bookkeeping. And so you learn something about, how the number of accounts relative to the possible set of transactions gives rise to aggregation. And you can relate it to something called the fundamental theorem of linear algebra, which says the dimension of the row space plus the dimension of the null space is n. So it's going to tell us that we get these two independent, or these two loops in the null space, these two things where aggregation occurs where we're going to lose information. So we can think about the information loss. We also, of course, can think about, given financial statements, to what extent can I work backwards to transactions given this structure. Anyway, enough of this linear algebraic structure. You've got it on the slides if you want to go through the rest. So what kind of theory is this? What kind of theory is this that we just went through? The math. Is it positive? Does it give you predictions? No, I don't think so, right? Is it normative? Does it tell you how to do accounting better? Well, maybe you could turn it into something normative, but it doesn't start out really as saying, here's better accounting, right? Maybe you could, use the way to think about it in terms of minimizing the effect of aggregation, or, how you want to think about analyzing financial statements in terms of, like you could start with the transaction vector that lies in the row space, which is the one that's closest, sort of the perpendicular one. You could do that. You could do things, you could turn it into more of a normative theory, but it really isn't that either. So what is it? It's more foundational, right? We're sort of trying to understand the structure, a way to think about double entry bookkeeping, but it doesn't really give us hypotheses, prediction that we're sort of looking for from theories, right? So it doesn't tell us in particular why accounting takes the form it does, right? So there was this call in the 60s, Beaver, Dembski, others saying, look, we ought to have models where we have a demand for accounting in the model itself, right? We shouldn't start by looking at measurements without there being an underlying demand for the information, so that we can understand the way why measurement takes the form it looks. We could look to decision theory, which was very much in vogue in the late 60s and early 70s, and think about the use of information for decision problems. And I think to some extent the FASB and IASB's decision usefulness and their conceptual framework sort of had their roots in looking toward decision theory, sort of being able to make better decisions. But the problem is decision theory doesn't seem to get us very close to what we observe in practice. There are a lot of things in accounting that would be difficult to explain taken from a decision theory perspective. Also, decision theory is going to tell us more information is always better, right? Which we don't, I think, typically believe in accounting. So let's not do decision theory, but that would have been a reasonable place to start. And then, we have Dembski pointing out that sort of a reinterpretation of Blackwell, which basically Blackwell says that if you have, a generic decision problem, and you want to know that one information system is better for any generic decision, not generic, any decision problem, any set of individuals, any problem they face. The only way you can know that is if you have finer information, right? So in other words, the information gives you a finer partition that you learn more about the state space. If I have one information set that tells me that the state is odd or even, and another one that tells me it's high or low, those are not fineness comparable, right? So I need something where I've got that, that comparison where, if one groups them into 1 and 2 and 3 and 4, the 2 states, the 4 states, sorry, so you got this partition of 2 elements, and the other one gives you a third element where it also will tell you the difference between state 3 and state 4, that's a finer system, right? We know that's better for decision problems because it gives you a more, did you understand what I just said? So you've got, 4 different states. If you've got one information system that breaks them down into high or low, so it'll tell you 1, 2 versus 3, 4, and then another one that will give you a further refinement. It tells you 1, 2, but then for 3 and 4, it breaks them out separately, right? Then you've got a finer system, then we're in business. We can say that the second one is better generically, but that's this is really the point of Dembski's argument. In accounting, we don't come by that. If you say historical cost versus fair value, you can't say one is finer than the other. So typically the debates we're having, at least in financial reporting, are not fineness comparable arguments. So basically we're not going to get anywhere thinking about decision theory as a way to help us understand how to choose among different accounting alternatives like historical cost and fair value. Okay, so Yuji, who was probably the strongest and most persuasive advocate for historical cost and for the stewardship perspective in accounting. I'm going to sit down. For the stewardship perspective in accounting says, basically it's got to be about some kind of stewardship problem, which isn't as narrow as an incentive problem. Right? Stewardship, his notion of stewardship, I think, is a broader notion. This will work, and then I can have fun rolling around. I just can't climb stairs. It's the distance between the heart and the foot. So this gets it closer. That basically, to understand practice, you really want to think of accounting as some kind of performance measurement. And then he emphasized, that you've got an accountor, an accountee, and an accountant, a tri-party relationship, right? And you have to think about how those three interact with each other to really start to understand accounting. And I think it makes, sort of intuitively a fairly persuasive argument. So that's where we're headed. And we're going to start with moral hazard and then move on to adverse selection, right? And I apologize for those of you that are not early PhD students but have seen all of this material before. Hopefully the next set of talks after the first one will be more interesting, or some of the talk later on will be more interesting. But basically, what's moral hazard? It's when individuals don't bear the full consequences of their actions. So what's the natural example to think of? Insurance, right? That, if you've got some kind of insurance, then you're not as careful as if you're uninsured, and so there's moral hazard. And it used to be that when you said moral hazard to your students, they kind of looked at you gave you a puzzled look. But after the financial crisis, and there was all the discussion about bailouts and moral hazard, everybody seemed to understand the word moral hazard somehow. Banking did it, or at least around that time period. I remember my students all seeming to know right away what moral hazard was. Sometimes it's difficult to tell whether a problem is moral hazard or adverse selection. So they did a study, I think this is from one of the Milgram and Roberts books, but they did a study where they looked at an intersection in a town and said, in that town, as a percentage of the total cars of a particular type that went through a stop sign, how many, what was the car that was more likely to go through the stop sign? Some of you know the answer to this. Don't answer. You might think, well, it's the kid in the sports car, right? So you might think there's going to be maybe not a Lamborghini, but some kind of sports car. It turned out no. What was it? What's the other end? What's the opposite of a Lamborghini? Don't say Honda. I have Hondas. So. How about a Volvo? Very safe, right? I could say it's a fun car too, but it's a very safe car, right? And so actually it was the Volvo that was the car that went through the stop sign, not the Lamborghini. And you can think of that, right, from the perspective of moral hazard, that you're insured because you're in a safer car, so you drive more recklessly. I actually don't think that's probably the most likely explanation. Could also tell an information story, right? And have something involving adverse selection, right? Who do you stick in the Volvo? Your teenage kid who you're afraid will kill themselves, right? Right. So you protect your kids by putting them in a Volvo instead of giving them a Lamborghini to drive around in. It's probably the old man in the Lamborghini who, drives it around at 20 miles an hour, or at least Corvettes are like that, right? Okay, so the separation of ownership and management is typically what we think about in terms of giving rise to moral hazard. The managers take unobservable actions that affect the firm's performance, but performance is also affected by luck, right, which makes it impossible to infer exactly what action the manager took. And we start from the presumption that owners have different preferences than managers do, right? So in particular that managers are effort averse. Sometimes we focus on risk. I tend to stay away from risk. I'm not saying that I don't believe risk aversion is important. I just like simple models. So I like to keep everything as simple as I can. So I'm usually working with risk neutral models. And at some point we should talk about why are simple models important, right? And I'll try to do that as we go along. So in this example, owners are going to prefer that managers shirk, but the managers work, but managers are going to prefer to shirk. And so once you've offered the contract to the manager is going to choose an action, EH or EL, that's unobservable by the principal. And then nature is going to act. And if the manager chose the high act, then it's more likely you have a high outcome. Sometimes I'll call that success. Than if the manager chose the low action. So P is going to be greater than Q. Do you have a question or comment? Yeah.
So you said performance is also affected by luck. So luck in the model plays the role of hiding the manager's action so that the observers can't invert the action or invert the outcome into the action.
Yes.
Are there other tools, modeling tools you can use to steer the manager's action, or is luck really the...
Well, you could think of it as talent too in an adverse selection model, right? That you can't figure out if, somebody, says, look, I had a, it's hard for me to produce because I'm less talented, versus hiding behind lying and claiming that I'm less talented when I'm really talented. But that's a case where the agent would know the realization of what we're calling luck here in the moral hazard problem, the type in advance, but that still creates an incentive problem. So that's sort of the crux of adverse selection, that it's, the type is known in advance, but only by the agent, not by the principal. Okay, so in the risk-neutral model, and the constraint is going to be that we can't pay a negative payment to the agent, and we're going to assume that his outside opportunity is small enough, that is, what he can earn elsewhere is small enough that that constraint isn't going to bind. So the only constraint that's going to bind is the incentive constraint, which makes sure that the agent prefers to work rather than shirk. You're not going to reward him for a low outcome. Why? Because that would happen more often if he shirks. So you're going to reward him for the high outcome, so you're left just solving one equation for one unknown to find the bonus payment. Okay? And again, both parties are risk neutral. The manager's utility is the payment minus effort. And let's assume that motivating high effort is optimal. You can write down a condition where that's true in these simple one-period models and be sure that you've got it nailed down, so it's not a big assumption. But instead of writing that down, we're just going to assume here that high effort is optimal. And so, and again, as I said, with the participation or individual rationality constraint, we're going to assume here it isn't binding. Okay, whereas in the risk-averse model, typically we assume it is a binding constraint. Yes, sure.
Has there ever been a case where you've seen it justified where low effort is preferred over high effort?
So let me see if I understand the question. So are you asking me if I write down the problem and solve for the optimal effort level, if it could be that the low effort is optimal and then we say pay 0 all the time to motivate low effort? Sure, you can go, you can motivate intermediate levels of effort as optimal, but I think you're asking probably something subtler, which is, are there times where you really want sort of not people to overexert, you want them to, and that's, I think, maybe Jeremy can help me with this, but or somebody else, but there certainly, when we had the scandals of Enron and WorldCom before SOX was introduced, there was a sense that incentives were too high-powered, right? And those high-powered incentives led, perhaps to high effort, but also led to excessive risk-taking. They led to manipulation in financial statements, and so that the incentives were too high-powered. And so to the extent that, modeling those other things basically creates a multitask problem where you could work hard, or you could manipulate, or you could, perhaps a third thing would be to take on more risk in the project selection. You can get more muted incentives out of models like that. Multitask models will lead you to more muted incentives because, you'll end up gaming the system in the dimension that's easy to generate performance, basically. It's harder to balance things across the different tasks. So that could be a way that, the incentives would be more muted, effort would be more muted because you have these other tasks potentially interfering with the one task you want to motivate. Holmstrom and Milgram is the classic reference to the multitask problem. Anyone else want to add something on that? Xiao, maybe? Yeah. You're not allowed to ask questions. You have to offer wisdom.
Just John Zhou, who used to be a Wharton, I think he's not Yale. He has some papers where he is basically saying, it's like continuous time model. Sometimes you really want to exert high effort. Sometimes you don't want to exert high effort. And how would a contract make it?
So how does continuous time feed into that?
It's more like from a dynamic perspective. It's just like it's just like how much effort you choose today. It's going to be affected by how much effort you think you're going to choose tomorrow.
I think the basic intuition is that sometimes it's too costly, just how much you promise the agent is too high for you to continue enforcing that he exerts
Yeah.
high effort.
So this sounds like even the two-period risk-neutral model where you can get, that what you want to do to motivate someone is count on a threat of potentially shutting down in the future. And so what you say is, if your outcome is high this period, we'll go ahead and motivate high effort again next period, but if your outcome is low this period, we'll shut down. And we'll do a model that looks like that where, basically you're saving rents to the agent with this ex ante upfront commitment to shut down, where you will have low effort along the equilibrium path, but actually it's something you have to commit to. You wouldn't do that ex post if you were writing the contract new every period. It has to be a long-term contract where you commit to shutting down. But it's basically the fact that you're trying to get the rents that you can earn by keeping producing in the second period help motivate the first period, right? So part of the reason you work in the first period is whatever reward you get in the first period, but it's also to continue along that path. You can think of it as turnover too, that if things go badly in the first period, you get fired. You don't really want to fire the manager, but you commit to doing that as a way of decreasing the reward you have to give in the first period so that the rents you earn in the second period can spill back to the first period and help motivate effort in the first period. So I don't know if that's exactly the same thing that goes on in the continuous time models, but that happens even in the dynamic, two-period model of this. Okay, so we write down a bonus that we need to solve for that makes sure that high effort is preferred to low effort, and I get the difference in the agent's cost of effort divided by the probability of success under high effort. So I'm just solving that one equation for the one unknown, B, right? And I get this equation. Of course, that's not the expected payment, that's the bonus. So the greater the agent's marginal productivity, PH minus PL, the smaller the bonus, right? The less the marginal productivity, the bigger the bonus. But that isn't what determines the expected cost of compensation. I've got to multiply it out first with a P in front, right? And so once I put the P in front, see if I've got it written here. I guess you can see it though right away. Right, if I just take this and divide everything by P, right? What do I get? I get 1, 1, and Q divided by P. So it says that likelihood ratio of Q divided by P, the likelihood of success under low effort versus high effort, determines the expected cost of providing incentives. So we get this focus, not just in risk-neutral models, also in risk-averse models on likelihood ratios. Okay, so what it tells us here is if you have more outcomes, you're going to always look for the one with the best likelihood ratio. That is the smallest Q divided by P. So what would you really like? You'd like Q to be 0. If Q is 0, you're going to get to an expected bonus that's exactly equal to the cost of effort, right? So intuitively, what does that say? If Q is 0, that if the agent shirks, you'll never get a success. So when you see a success, it was because of high effort, or at least had to have exerted high effort to get that. And then I can rescale for luck and get so that the expected bonus is just exactly equal to the cost of high effort. So I get rid of the incentive problem in the case that Q is 0. Okay, so for an example, if I've got P of 0.8 and Q of 0.6 and cost of high effort of 1 and the cost of low effort of 0, what's my bonus? 1 divided by 0.8 minus 0.6, or 5. And what's my expected bonus? 0.8 times 5, or 4. Okay, and we're going to come back to this example when things get more interesting with multiple agents and other problems. Okay, and here it's a problem of rents. It's not a risk premium, right? Because it's not about the agent being risk averse. It's that the agent is earning more than their reservation wage requires. So what's the agent's expected utility? It's that 4 minus the cost of effort, or 3, whereas we said their outside opportunity would give them 0. So it's the rents that the agents are earning in excess of their cost of effort, the 3, that is the rent, that 3, that we think of as the agency conflict. So we're trying to reduce that with the solution. There the likelihood ratio is written out. Okay, so typically we reorder the outcomes so that the monotone likelihood ratio property is satisfied. So what does that say? It basically says in the risk-neutral model, we're going to reorder the outcomes in a way that you're going to make a single bonus payment for the highest outcome, because it's going to have the best likelihood ratio. Okay, when I say reorder, just think of the outcomes as having this property. If they don't, just reorder them so that they do. Basically this makes the problem easy to solve. And what you'll get out of the risk-averse model is you'll get payments that are monotonically increasing in outcome. So it won't tell you that you make a single bonus payment for that highest outcome, but it'll tell you the ordering of the payments in the risk-averse model. And then we have another, just to get some, so when you see these conditions, I'm not expecting that all of you will model and write these things down, but at least you'll know what they're there for. Right? So CDFC, concavity of the distribution function, basically saying they're diminishing returns to effort. Right? So what does that mean? It means that if I'm trying to motivate, again, suppose I've got, not one effort level, but not binary, but maybe 5 effort levels. If I want to motivate level 4, what's going to be the binding constraint? Making sure that you don't want to choose 3 rather than 4, because those are the 2 that are going to be closer together. If I go down to 2, there's going to be a bigger gap. So if I can just make sure that you want to choose 4 rather than 3, I know you'll want to choose 4 rather than 2, and 4 rather than 1. And of course, you won't want to jump up to 5 because that's an even smaller return, right? They're decreasing returns to effort as you go up. So it lets you look at adjacent constraints. Basically, it says when you're solving the problem, you just need to look at the next lowest effort level to figure out what it is that, where the binding constraint is. If we didn't have this bankruptcy constraint, what would the solution be? Sell the production technology to the agent for its expected value. The agent would take automatically whatever effort is optimal because they would own the technology. So what prevents you from selling it to the agent is that the agent can't experience negative utility. Risk-averse model, I think we've talked enough about that, but basically the friction there is, you typically have models where both the individual rationality and the incentive constraint bind, but the cost there is not rents, rather you're holding the agent to his reservation wage, but it's the risk premium. You have to impose risky compensation on this agent who, to bear that, needs to be paid more because they don't like risk. And that's the cost of the agency problem. Okay, so let's think in terms of the classic result in accounting, Holmstrom's result. Let's suppose there's a shock. And I think on a later set of slides I'll call it sigma, but for here it's F. So there's some chance that the agent gets lucky, and no matter what his effort is, the outcome's going to be high. Right? And we're looking for a way to potentially filter that shock out eventually. Right? We'd like some way of getting rid of the shock. And so we're going to have the same kind of setup as before, but we've got this extra shock of F to deal with. So what is F going to do to the problem? So it's the same pH or P and Q. Did I do P and Q or pH and PL? P and Q, I think, right? So I have the same P and Q with probability 1 minus F, but with probability F, the outcome is always high. What's that going to do to our problem? Think of the incentive constraint, right? So I'm going to have, now when you work, there'll be a 1 minus F times what we had before, and then a F. And when you shirk, there'll be a 1 minus F times what we had before, and an F. Of course, it sounds like it doesn't matter, but the 1 minus F is going to increase the bonus, right? Because you're going to now have that 1 minus F left after you get rid of the F's. But you're going to pay out the bonus with probability F plus 1 minus F times P, right? So the fact that you pay it out, that it includes the F, is going to make it costly, right? If you could find a way to pay it out only when the 1 minus F was in play, then we'd be okay. We would have just rescaled our original problem. It's the fact that we have to pay it out with probability F also that creates the problem. So there's the incentive constraint rewritten, right, with the bonus. And so I get for our problem, the bonus goes up to 10 if the F is half the time, which sort of makes sense, right? That you've got, half the time you're getting lucky, so you've got the 1 minus F is only half the time, so the bonus has to adjust for 1 minus F, it's got to double. And again, if you were only paying it out with probability 1 minus F, wouldn't be costly. What makes it costly is that you're paying it out with this extra half a chance in the front. So you end up now with paying the agent in expectation 9. The agent's rents went up from, what were they, 3 before, now to 8 because of F. F caused us a lot of trouble, this extra luck. And we complain, about stock options being dumb. They've gotten smarter over time, but that basically, the market goes up, everybody gets rich because equity prices increasing mean more of the options are in the money. That what we really should do instead is what? Some kind of indexing, right? Where you say that your stock has to go up more than your competitors or more than the general market, so that it really captures what you've done relative to the overall market. So there are more of these now, more stock options that have performance conditions built into them before they vest, for example, that would include beating the market or beating some industry average. There are vesting conditions like that written into some employee stock options or restricted stocks. So basically the argument is what? That if we used relative performance evaluation, somehow we could help deal with the F. Right? That the market just going up because everybody's doing well probably doesn't have to do with your own CEO's effort, and we might be able to filter that. I don't think that's completely unambiguous, right? It could be that you actually want to reward your manager when the market goes up as a whole, right? That's interesting to think about, but the sort of standard argument is no, you don't want to do that. You don't want to reward them when the market goes up because that's not about their effort, that's about luck that the market's going up. So let's suppose we've got 2 agents, and we've got now an outcome that, your outcome could be low, your competitor's outcome could be low, low, high, high, low, and high, high. So what's the magic outcome? Well, one way to do it is say, I know I'm looking for a good likelihood ratio. Okay? And then think about the intuition. Where do you see a good likelihood ratio? So first of all, you've got to talk about the equilibrium concept. If there are 2 agents, we've got to decide, do we want to make sure that working is preferred no matter what? That is, that it's a dominant strategy, no matter what the other agent does? Or are we going to hold the other agent constant at high effort, which is what a Nash equilibrium is, right? We can assume that the other agent will always be working and then vary our agent from working to shirking. So that would be where? That would be HH versus, say, LH, right? So the second agent is being held at working, and the first agent is considering, given that the other agent is working, changing from high to low effort. Okay, so if I'm looking just here, let's do the Nash version. What looks like a good likelihood ratio? Which of these outcomes? Comparing this number to this number. This one actually looks familiar, doesn't it? What was the likelihood ratio before we had F? 0.6 divided by 0.8. What is it now? 0.06 divided by 0.08. Why is the likelihood ratio the same in this column as in our problem without F? How do I get back to that same likelihood ratio? How does that happen? What's the intuition for why the likelihood ratio is the same here as it was in the problem without the F? Again, let me make sure you understand what F is. F says that everybody gets lucky. So no matter what effort is, you'll have an outcome that's high. So how can I get rid of F? When do I know F was not in play? If I see LH or HL, right? Because I know that they didn't both get lucky, right? So by focusing on HL, I know that we're in the 1 minus F part of the world, right? So I won't have, and if I use that, then I won't have to pay a bonus out when F is in play. So all I've done is rescaled the problem for the 1 minus F. Now I've also got the other agent's effort in here, so that's going to further rescale things. But basically I can get back to my original solution by plugging in 1 over 0.08 minus 0.06, which of course means my bonus is now what? What was it before? 5, now it's 50. So I'm going to pay out a bonus of 50 with probability 0.08, which is going to give me an expected bonus of 4, minus the cost of effort is 3, so we're back to our original rents of 3 to the agent. Interesting here to think, though, what could go wrong? Well, you're paying out a big bonus with a small probability. Do you want to count on that? If you start to think of this in the real world, how confident are you that you would really know these probabilities and have them right? What if maybe the probabilities are much higher and you end up paying out this bonus of 50 with a much higher probability? Then this contract doesn't sound so great, right? The relative performance evaluation contract. So those are sort of, where you might complain about the standard model, right? That the standard model assumes we know all of these probabilities, we know the agent's disutility for effort very precisely. Whereas we may not, and then the solution could be very bad. So to the extent that this is a very fine-tuned solution, we might be nervous about it, but the basic takeaway here is relative performance evaluation can get rid of the F-shock, right? And so the controllability version of this is to say, I'm going to condition your pay on the other agent's performance, even though you don't control the other agent's performance, right? Your effort does not enter in to the other agent's performance. However, given your own performance, the other agent's performance does tell you something, right, that's useful, that helps you filter out noise. So that's conditional controllability or informativeness. That is, the conditional probability of the other agent's performance, given your performance, does depend on your own effort. Right? So you have to think in terms of conditional probabilities, not in terms of unconditional probabilities. Because if you just looked at, the traditional mantra of managerial accounting of you should be paid for things you can control, the naive interpretation is you don't control your competitor's performance, so you shouldn't be based on your competitor's performance. But given your own performance, your competitor's performance is affected by the conditional probability of your competitor's performance does depend on your own effort. And that's what Holmstrom is all about. There is a Mario, you had a question or comment? Yes. Yeah, so it affects the ability to do this, to extract. It affects the cost of doing this, but qualitatively it still shows up. Right? So relative performance evaluation shows up in the Holmstrom model, which is a risk-averse agent. But of course, you're right. You're imposing risk on the agent. So the volatility and compensation is costly, but the fact that you're doing it with this additional information means that overall you're better off. So the net effect is that you're reducing the risk premium by using the extra information. Labels matter. So anyway, that's the solution, right? We just talked about. I find when you teach students, yes, please.
I just have a question. Like, why is it that talent's not as common in model as luck and effort? Is it because talent is not observable as well, inseparable from luck? But
so this is back to the question before about talent and luck and why you don't have them both in the model at the same time. So absolutely, you could model somebody up front knowing something about their type, or you could even have talent that you learn about over time. Those are career concerns models, what we call career concerns models. But the point, what we're doing right now is we're trying to keep it as simple as possible and focus on the impact of luck. Okay, so this is back to the comment I made earlier about, sort of why you do a simple model. Right, so why a simple model? Actually, I liked what Fleiter said at the Stanford camp. He said, one of the advantages of a simple model is it just makes it easier to see whether somebody's committing fraud or not. That basically, if it's simple enough, he made an analogy between modeling and, which is controversial, between modeling and data, people that fabricate data. You know, the people that make ridiculous assumptions that don't have anything to do with the real world could be thought of as not so dissimilar from people that fabricate data. I think there's a difference, you know, that basically, you know, at least if you're transparent, you can see what assumptions are made, right? Whereas presumably you can't see if somebody's made up data. But, you know, there's a point there that, you know, it's a simple model where you lay things out, you know, as clearly as possible, and also helps illustrate what's the driving force. If I put lots of different forces into a model, it's going to be difficult for you to see what's driving the results. So the idea is to sort of just put enough in the model, not to be realistic and capture the real world, but to illustrate the force you're trying to illustrate. Now, as you build models that become richer and you understand the basic building blocks, you probably have a better shot at sorting out what's driving a more complicated model. So that's another thing to sort of give you a benchmark of what the simple model looks like. But you know, you could have both of those things in the model at the same time, and people do, but we're just not starting there. I don't know. Jeremy has something better to say about that. Yeah, no, I wish you'd comment on that.
You know, no, it's an interesting point. So how do we disentangle? What does the theory say we should do in order to disentangle the pure moral hazard and the pure adverse selection? What is the different predictions of these two types of approaches?
I don't have a good answer. So, you know, from adverse selection models, even with risk-averse agents, I get rents, right? I get information rents, because I've got to basically pay somebody to, so to some extent, you know, out of the classic moral hazard model with a risk-averse agent, I don't get rents. So that would be one difference. Help me. There are a bunch of you here that have plenty of experience. What do you think the key differences are?
A theoretical question, how do we
Yeah.
separate the two?
To sort out, you know, what am I looking for to sort of see? I mean, that's one of the problems I think that, you know, you encounter in structural estimation work, which I know almost nothing about. Whatever I've learned from Jeremy and Chen, and I've not been listening carefully enough. But basically, you get these simple models, like a moral hazard model, where you know that, you know, and you're trying to estimate something like the agent's risk aversion. And you know there's probably adverse selection in there too, and it's getting jammed into that estimate of risk aversion. So part of what you're seeing is volatility in your estimates of risk aversion that don't have anything to do with risk. What they're capturing is maybe hidden information or something else that's left out of the model. Okay.
Jonathan,
Yeah.
you know, I really wrestle around with trying to squeeze out the risk element of this. Especially today, I wake up and I see HSBC has fired their chairman after 18 months on the job. And it makes me ask the question, what is the board trying to accomplish? And my gut tells me they're obviously not delighted with his performance.
Yeah.
But are they going into it and saying, listen, we have this business model, a global platform. We want you to push it harder. We want you to push extremely. And to me, that implicitly means
more risk.
taking the risk up.
Yeah.
They want more performance out of it.
Yeah.
I look at Ford Motor Company, fires Mark Fields, not because he ran a terrible Ford Motor Company operationally, he was making billions of dollars,
Yeah.
but because he couldn't compete on value compared to Tesla.
Yeah.
So the board goes and replaces an auto guy with a furniture guy.
Yeah.
And suggests that they want to do something different.
I take it you think something's wrong with
Exactly.
replacing a furniture guy.
Everything smells and feels like they're jumping into the risk framework and
Yeah.
wondering how much can I push the envelope on these companies and the enterprises and the business platforms.
Yeah.
And so when we squeeze it out of the analysis, shouldn't we be, I mean, to me, I want to know what that risk is. I want to know if they're flooring the gas pedal on those companies and I'm going to get a breakage like I had in Enron. Or is it something that they're tapering it back, which is maybe Facebook today, because of the shots across the bow on changes in regulations and oversight on Zuckerberg?
Yep. You know, I think basically we're talking about different kinds of models, but you know, models where you're looking at CEO replacement, which I studied some of those models. You know, you can think of it as, you know, maybe you've learned something about the existing CEO because you become more familiar with them and you know where they lie relative to the distribution you're looking at. And by going for a new draw, you're taking on risk inherently because you know less about them. So sometimes it may look like, you know, you're going after a replacement that doesn't inherently look better, right? It just looks riskier, but that can be optimal because if, you know, the distribution you've got from the guy you know is you know, not what you're after, then a new draw maybe gives you a chance at getting that distribution you're after. But these are certainly, you know, problems beyond where we are in the modeling right now. Okay, so another version of this is I just relabel everything and call it revenues and expenses. Well, then students tend to quickly, if you're talking to MBA students or undergraduates, is they tend to quickly say, well, you know, the agent, if they work, the probability of revenues is different than if they shirk. But the probability of expenses, which are the, if you look at the 120 and 60, right, whether you work or whether you shirk, the probability of getting expenses of 120 is 0.6, and of getting expenses of 60, low expenses, is only 0.4. So they quickly gravitate to the agent doesn't control expenses, they control revenues, so they should be compensated based on revenues. So the point I'm trying to make is basically the framing of the problem can often, you know, lead people to think differently about it, even though it's the same numbers. You know, you put it up one way, you put it as comparing your competitor's stock price to your own stock price. It sort of seems intuitive that you could filter out something, some noise in market prices. When you do it with revenue expenses, at least for undergraduates or master's students I've taught, they often aren't as quick to see that it's the same problem, essentially. Okay, so let's go back to our problem and write out the game with two agents. So we're going to do our bonus of 50 with probability 0.08, but see what the actual 2x2 game looks like for the agents. So what's this? This is when they both work. Remember, they got with probability 0.08, 50, which is 4, minus the cost of effort is 1. But if one agent shirks and the other one works, it turns out the second agent, the agent who is working, ends up getting 7. What's the intuition there? Why do they do so much better? Well, you're getting paid well if your competitor does badly. How does your competitor do badly? Well, if they shirk, they're more likely to do badly. So you increase the bonus that the other guy gets if you shirk, right? And so, what's that? That's right. That's right, and vice versa. So basically, the game now, yes, it's true there's a Nash equilibrium, but if you think about repeated play, it's tempted to think if they're going to face each other over and over again that they might find some way to coordinate on better payoffs, right? So it's not true that 6-6 is an equilibrium either of the one-shot game, but you can imagine that they either might find a way to get to 6-6 by threatening to revert to the play that would get them back to the stage game payoffs. Stage game means one-shot game. Right, so they would say, I'll shirk as long as you shirk, but if I ever see you working, then I'm going to work forever after, which sounds like a funny kind of collusion, but that's the kind of collusion here. Or, more interestingly, actually, it turns out that if you look at the payoffs, we talk about a complementarity, strategic complementarity in payoffs or substitutability. And so what a complementarity means is when you're working, I'm more productive. I get more return from my own effort. Whereas a substitutability is the reverse. When you're working, I get less from my own effort. What kind of game is that? All you're doing is comparing the numbers. So is there a bigger return to my effort here in terms of the difference in terms of those two numbers, or here. First one, right? There's a difference of 1, here there's a difference of 0. So that's a game with strategic substitutability and payoffs. And actually in games like that, what's going to happen is the collusion is going to end up, once we look at the optimal design problem, invariably being not that they both shirk, but rather that they take turns, with one working and one shirking. So when the principal tries to design a contract to upset this, the constraint that's going to cause trouble is the collusion where they would take turns making each other look good. One period, I'll work, you shirk, and then we'll do the opposite the next period, and we'll go back and forth like that. I think given how late it is, I'm just going to keep talking until 10:30. I know 2 hours is a long time, but I promise not to do that for the second session. Second session, we'll take a break in the middle. Okay, so let's try to just keep going since we're about half an hour out from a natural break, and then we can make up some of the precious time Jeremy stole from me. So, you could ask that question. What would it take to make EL an equilibrium in the repeated game, assuming that the agents observe each other's actions so that they can retaliate? We can have imperfect monitoring where the agents observe something, maybe even just the outcomes, right, which Jeremy knows more about imperfect monitoring than I do. But basically the assumption I'm going to make is that they see each other's actions. They work closely enough that they can see each other's actions, and so they can react to the actions of the other agent. This is going to be infinitely repeated. We'll talk about finite repetition in the next session. Okay, so we're going to play this forever, which is sort of hard to swallow, but you can think of this as, there's a probability of 1 over, if the discount rate is R, 1 over 1 plus R, which we call the discount factor, that you're going to continue until the next period. So with probability 1 minus that, you'll die or quit or whatever. And with probability delta, you continue to the next period. So it doesn't have to be that people live forever, but it has to be that they have the potential to live forever. Okay, so we could ask, what's the discount rate that will ensure that that 6-6 play is self-enforcing in the sense that it's a subgame perfect equilibrium, which means that at any stage in that part of the subgame, it's a Nash equilibrium from that point on. So the way these things work is you say, we're going to do something that's not an equilibrium of the one-shot game. In this case, both shirk and get the 6. And again, the threat is, if I ever see you work, then I'm going to work in all future periods. So what's on the left-hand side? That's your temptation to renege today. If you're both playing 6, you can deviate and work and get 7 instead. So that's your temptation to deviate from that collusion today. What's on the right-hand side? The punishment forever of reverting to the working equilibrium instead of the shirking equilibrium, right? Okay, so as long as R is less than 3, not a third, 3, then you end up with, so delta is 1 over 1 plus 3 or a quarter. So there has to be at least a quarter of a chance you'll survive and play in the next period, if you want to think of it that way, in order to support collusion. So another downfall potentially of relative performance evaluation, right? That there could be collusion under relative performance evaluation because you're creating this not multiple equilibria in the one-shot game, but rather there are multiple equilibria that could be collusive in the repeated game. What other problems does relative performance evaluation have? Well, like we talked about before, it's fine-tuned. Right, so I think this probably fits more with adverse selection, but there's this lovely quote from Bob Wilson, who was sort of the key person that developed information economics at Stanford. Many of the famous people somewhere or another were a student of Bob Wilson's. So what does he say? The optimal trading rule for a direct revelation game, so this has more to do with adverse selection, but you can think of it here too, generally depends on the agent's probability assessment about each other's information. If left in this form, therefore, the theory is mute on one of the most basic problems challenging theory. I refer to the problem of explaining the prevalence of a few simple trading rules in most of commerce conducted, The rules of these markets are not changed daily as the environment changes. Rather, they persist as stable, viable institutions. As a believer, so here's the positive theory side, as a believer that practice advances before theory, and that the task of theory is to explain how it is that practitioners are usually right, I see a plausible conjecture. These institutions survive because they employ trading rules that are efficient for a wide class of environments. Okay, so what's he saying? We take the mechanism too seriously. We take the contracts too seriously. We fine-tune them to these very specific and precise parameters, and we can end up with, I think of it as, contracts that can look knife-edged, that if things were a little bit different would blow up. So we need something that would work, even if we're off a little bit with the parameters, so that it would work with slightly different parameters. And so my way of looking at this, and I did some work with Arya and Joel Dembski and Pierre Liang on this, but also some other work, here's the moral hazard version, is let's suppose that, that one of these parameters, so let's suppose we've got two independent signals, and so it's like our other problem that we just went through, but that for one of these probabilities, the principal doesn't know the p. So instead, p is distributed on some interval uniformly to capture maybe diffuse beliefs, at least that was my intention. So in the sense that you don't have any reason to think that one value of p is more likely than another. This matters. It matters on, matters what you assume about the distribution. So here I'm assuming that the principal thinks that p, or what I'm calling pH here, is uniformly distributed between pH minus epsilon and pH plus epsilon. And what's the superscript for? It's for the performance measure. There are two different performance measures. 2 is the second one. Okay? And so if the bounds are small, the contract ends up looking like what we had before. That is, you pay only for, what did I do here? There are two independent signals. So this isn't really relative performance evaluation, right? There are two measures of your performance. There's stock price and their earnings. And one of those measures, the principal knows the probability distribution of. That's measure 1. And the second measure, the principal only knows that p is uniformly distributed on some interval. Okay, and so what happens is that when that interval is small, it's optimal for the principal to use both measures. But of course, it results in additional rents for the agent, because you've got to make sure, if you want to make sure the agent works no matter what, for all epsilon, you've got to make sure that it works for the worst epsilon. And what's the worst epsilon in this case? It's the one that is on the left lower bound of p, basically the smallest p. So you're designing a bonus, so your p minus q is going to be smaller, the bonus is going to be bigger, but you might pay it out with a bigger probability. In particular, you might pay it out with p h plus epsilon. And so on average, how often are you going to pay it out with probability p? But you're designing the size of the bonus based on the epsilon, the lower bound, minus epsilon. So you end up, if that bound is small, you just end up paying them when you pay the agent only if both performance measures are high. But there's some extra rents to the agent. But if the bound is big, it can be better to just forget about the second measure and leave it out of the contract, to just pay the agent based on the first performance measure. Now it turns out with a risk-averse agent, you get a different result. So with a risk-neutral agent, it can be optimal to ignore the measure because of this extra problem. With a risk-averse agent, you'll still use the measure, but you'll use it in a more muted way. There are questions? I told you I hadn't looked over my slides before today. Sorry for the fumbling a little bit. Yeah.
So the agent knows the distribution of the
That's,
signal.
yeah, the agent knows both. So the idea is that the agent, the agents arrive to work for you. You hire these two people, they come and work for you for a period, then you have these two come. They know when they come what their P is. But you as the principal just have a distribution over the second performance measure. You don't know exactly what the P is. So there's some notion of the contract has to be generic enough to accommodate different P's. Now, why don't I have epsilons floating around everywhere? Simple model, right? That's my plea for these things, right? I just want to keep it simple. But I could have epsilons everywhere. I just wanted to, keep it as simple as I can. So there's one measure that's maybe harder to understand, where the principal doesn't know the P as well, but the agent coming into it is going to have an information advantage.
Also, do you have restrictions on the distribution? Like, does that work for like normal or just?
So it does matter. So basically, if you've got a more concentrated distribution, then you can end up focusing. So let's think about a bigger model where we don't know whether high effort or low effort is optimal. We can end up with, within that, the central tendency of the distribution in that area, that we make sure that we get high effort, but outside of it, in the tail, we give up and say, oh, let's not worry about that. Let's let the agent shirk. So it does matter. It's the uniform distribution that makes it very clean, and it's basically saying that if you knew the distribution was very likely to be in the center and the tails were thin, then you just give up on the tails and worry about making sure you motivated effort for the central part of the distribution. Basically, you end up with corner solutions because of the uniform distribution, where you either, where you want to motivate high effort all the way through. So it's a very simple take on the notion of robustness. That basically, I've just crudely said, the agent knows something the principal doesn't. Normally, we would think about communication. Let the agent report to the principal. Well, that kind of undoes the whole idea of making it robust. So we're going to block communication, not let the agent report anything to the principal, and just say, let's design a contract that works no matter what, and then we can end up with a different prediction. And if you notice, it isn't just about likelihood ratios. For the first measure, P1, there's a condition. The condition depends on the likelihood ratio. For the second measure, it's about marginal productivity. It's about pH minus PL. It's not just about likelihood, or it's not about likelihood ratios anymore. So why would pH minus PL matter? Because basically, if pH minus PL is small, if your marginal productivity is small, what happens? The payment blows up, becomes very big. And that's exactly when you have a robustness problem. When the payment blows up, you get stuck with, maybe paying out something that's big with a high probability by mistake. So you don't want to do that. When I say by mistake, I mean, if you're on the other part of the distribution. There are lots of other, attempts that people have made in economics to get at robustness, but they focus typically on higher order beliefs. So when we talk about, a Nash equilibrium, it has to be common knowledge, which means that I know, that you know, that I know, that you, ad infinitum. It's how far you're willing to go. They focus on that in the economics literature, not on this, what I think of as a very simplified approach, which is just that there's, something the agent knows, where they know the precise parameters, principal doesn't know it. You've got to design a contract that works for everything. Okay, adverse selection. We finally made it to adverse selection. Yes?
Going back, so the cost to the agent is the cost of that.
Yeah.
And that's that. So there's sort of a quiet life argument there that somebody's had first.
Yeah.
The agents, they're hardworking, ambitious people. If anything, their cost is that they are empire builders. They are willing to work
Yeah.
hard as long as they can maximize something else.
Yeah.
Models or plausible
Yeah.
models.
So absolutely, they're
Instead of
part of it's interpretation. So one thing to do is just to say, let me interpret low effort as spending time working on something that doesn't create firm value. So I'm going to work really hard, but it's on something else. So it's a diversion of effort away from something that benefits the firm to something that has more personal benefit. But there are also models where you have, an empire building, so you tend to, maybe be tougher in terms of the hurdle rate that you impose to avoid the empire building. That's another way, but different implications. But so I'd say yes, you can interpret it differently. That's one answer. Another is, to actually model something like empire building, which can give you different results.
But part of the interpretation will depend on the relationship between effort and outcome, right?
Yes.
So the idea is the harder your words, the more favorable the outcome.
Yes.
Right? So that's going to be part of
But I could think of it that if you shirk, the outcome distribution is worse, but instead you're getting something else out of it. Like you're not shirking, you're working hard on training that will benefit you if you go to work someplace else, right? So it doesn't mean that you're lazy sitting around doing nothing. It can just mean that you're spending your time on something that doesn't benefit the firm. That's the simplest interpretation. But there are interesting things to look at, like empire building, to actually model empire building. Tim Baldanius has a nice paper in the Accounting Review on empire building in a capital budgeting context. There are more papers in finance and economics, but in accounting, I think that's at least the first one that looked at empire building. Lots of application, lots of successful, or you could argue successful application of adverse selection models. Usually when they've blown up, it's been around robustness issues and it's been around collusion. That basically, you design some wonderful auction and then you find out these same parties play with each other over and over again, and they find a way to collude and get good prices out of the auction that wouldn't happen if they weren't colluding on their strategies. But there are lots of direct applications from information economics of adverse selection. I think we can argue that we see them at least qualitatively very easily for moral hazard, but there's more of an industry of academics who go around and do consulting on how to design auctions and other things, or how to use information economics to think about selling ads on online, or how much you'll pay for information about the customers who are searching. So more direct application of information economics. Does Hal Varian still work for? Do you know, Jeremy, if he still works for? Was it Google? He was working for Google. Was it Google? Still working for Google? Yeah. So you see more of that here, whereas you don't see. You see people sort of qualitatively saying, the moral hazard model tells you should use more relative performance evaluation. Why don't we see more of that? Or why do we see CEOs have so little of their wealth? 20, 30 years ago, people were arguing this, tied to firm performance. It looks like it's suboptimal effort motivation, that they ought to have more options. And that led to sort of a wave of increased stock options, which created their own problems. But it wasn't as fine-tuned as, here's how you design an auction for selling off, telephone bandwidth or whatever it is, where there has been more direct consulting in the adverse selection area. But we can also think about it from a positive standpoint, trying to understand things like, why don't we use the NPV rule in practice literally? Why don't we accept all projects, even though this has been in accounting textbooks for almost 100 years? Why don't we see in practice every firm accept all projects that have a positive NPV and reject all projects that have a negative NPV? Why do we see them doing things like saying, well, our true cost of capital is 5%, but we want to use a hurdle rate of 6.5%. And you ask them why, and they say, well, that's what we've always done, and we worry about people fudging the numbers, and we're worried about risk that's not being captured, but they won't let you use 5% in practice. Or they'll say, okay, we can do NPV, but we've also got to look at payback. And you're scratching your head, payback? Come on, how dumb is payback? But they want to use that in addition to NPV. Or they want to use IRR. What's wrong with IRR? Internal rate of return. So if your cost of capital is 5%, and you only take the projects that clear, say the best projects clear 6%, what's the problem? Again, you're using too high of a discount rate in evaluating the projects, which is particularly going to hurt long-run projects, right? So if it's a project that generates returns over a short horizon, you're okay, maybe it's close enough. But when the returns are way out in the future, so you just, if you take the old textbooks, you just beat yourself up and think, why are people so stupid? Why can't we get them to use NPV? And the answer is, they're not stupid, we're stupid. Right? Why are we stupid? Well, maybe we're all stupid, but I think the reason that we're stupid is we're not thinking about incentive problems, right? And they are. They know incentive problems are important. They know that people want projects to go through. They know if the returns are mostly generated 30 years from now, they think they can lie about them more easily than they can if they are generated in the next 2 years. And so presumably they know that things like IRR help handicap those projects that generate returns further out in the future. Right? So we can think about, simple versions of those models, but I think there's probably more work to be done there too. So let's just, do the simple information economics version. Let's suppose you've got something like a printer, or let's say a data source. You can, access data. You can have a normal version that is a little slower. So you add some code to slow it down. So actually the normal version is more expensive because you've added code to slow it down. Whereas the better version that you want to sell, the high-end version, has less code, doesn't slow down the person accessing it, it's faster, but the marginal cost of either of them is 0. Once the code's written, right, the marginal cost is 0. And you've got two types of customers. 60% of your customers are normal. They would be willing to pay 10 for the low-end product, 15 for the high-end. And 40% of them are fanatics. They really like the high-end, and they even like the low-end better. They're willing to pay more. Okay, so you've estimated this from information you have on your customer base. What are you going to do? And you can't price discriminate. You can't find a way to sort of identify who is who and sell one version to a customer at price X and sell that same product to a different customer at a different price. You got to offer, you can assign prices not to customers, but prices to the versions. What are you going to sell? And at what price? And so the idea of utility functions here, we should probably say something about just the difference between your willingness to pay and what you actually pay. So if you'll sell me the high end for 40 and I'm a fanatic, I get $10 of utility because I was willing to pay 50, but I only had to pay 40. So we'll just call that 10 in utility. So it's just the difference between what you would be willing to pay and what you actually have to pay is your utility. What are you going to do? Yeah.
So you charge $10 for
Okay, so you're going to charge 10 for the normal. So 60% of the time you're going to get 10, right? So you're going to get 60% 10, and you're going to get 40% of 40, another 16, and the total is going to be, what did I say, 22? 6 and 40% of 40. 40% of 40 is 16, and 6 out of the first one's 22. Did I do the math right? So that you get a total of 22 from your customers. Can somebody do better? I should have found somebody that wasn't so good. Why 40? Why not 50? So the first one you're going to sell for 10, you said. Second one, you're going to sell the high-end one for 40. Why didn't you charge 50 for the high-end one?
Those 40% of people will go to buy the
Yeah. If I try to charge the high-end, the fanatics 50, they're going to get nothing out of buying the high-end product. They would switch, buy the low end, and get rents of, what was it? Rents of 10. So I can't charge them 50. So to make it incentive compatible for them to reveal to me that they're the high type and buy the high product, I've got to charge only 40. Okay? So, what are the different things you could do? You could sell the product to only one type of customer. If you're going to sell it to only one type of customer, who are you going to sell to? The one who will pay you the most, the fanatics. What product are you going to sell them? Well, they're all marginal cost of 0. Sell them the high-end product. So you could get 50, but you'd only get it from 40% of your customers. You'd get 20. Right? You could do that. You could sell the low-end product to everyone. Sounds kind of like a dumb thing to do. But you could do that. That's going to get you less. So it turns out, what's your name? Kevin. What Kevin proposed should be the optimal one, I think. Is it always going to be optimal? So what would make you want to do something different? Think in terms of probability distributions. So let's suppose 99% of your customers are fanatics. What do you want to do then? Sell the high end for 50 and forget about the regular customer. What do you want to do if 99% of your customers are the normal customers? What do you want to do then? Again, 99, so basically everyone, almost everybody is a normal customer. What do you want to do then? Sorry, somebody? Sell the high end for 50, right? Because it's really important to get as much as you can from the 99%. So you'll end up, which that's efficient production for the low end or the normal customer, right? The low type, right? So that's what you would do in a first best world, right? If you could price discriminate, you would sell only the high end product and you would charge two different prices. You would charge to the fanatics 50 and to the normal customers you would charge 15 if you were allowed to price discriminate. So I can get very close to that if the distribution is extreme, right? Because I don't have to worry about the 1% that's left in the other side. So what I'm doing under Kevin's solution is I'm rationing. I'm rationing to the low type in the sense that I'm not selling them the high-end product. I'm selling them instead an inferior, slowed down product with code. Why am I doing that? Why did I add that code to slow it down? So that I could reduce the rents that I pay to the fanatic, the high type, right? So there's always this trade-off in these models between inefficient production for the low type and rents to the high type, right? So how do I get rid of all the rents to the high type? Just don't sell anything to the normal customer, right? They completely shut down. Then there are no rents. The solution that Kevin proposed gives some rents by having some production, right? Whereas if I did the full first best production of producing the high-end product and selling it to the normal customer, then I'd have even more rents, right? Because I'd be forced to sell the high-end product to the fanatic customer for, what did we say they would pay for it? They would pay, the normal customer's only willing to pay 15. So then they earn lots of rents. They get something worth $50 to them for 15. They're earning $35 in rents. So again, the trade-off is between inefficient production for the low type, the normal customer, and rents that you pay to the high type. To the high type, are you ever going to sell them anything besides the good version of your product, the high-end version of the product? So again, for the low type, whatever you sell them, other than nothing, right? Anything you sell them is going to create rents for the fanatic, the high type customer. What about the high type customer? Is what you sell them, does that create rents for anyone? For anyone else, another type? No, right? So what you do for the high end then is first best. You always are going to sell them the high end product. The fanatic's always going to get the high end product. Because what you're focusing, what's the incentive problem here? Whatever you sell to the low end because of the adverse selection, because the high end customer, the fanatic, sorry, has private information, they can use that against you and earn rents. So what I'm trying to do is trade off two things. Rents I pay to the fanatic and inefficient production to the normal customer. The normal customer will never get rents, right? They don't earn rents, but they create rents for the high type. So that's the trade-off in adverse selection. I have a feeling we're all getting tired, but does that make sense? So basically adverse selection, it's this trade-off between rents to types above you and for type whatever T, their production can create rents for types above them, right? Not below them. And so that's what results in inefficient production for that particular type. Since the highest type doesn't have anybody above them, you don't do inefficient production, you do first best production. Okay, and then you can change the probabilities and get different answers. Here's modeling it out. What's the participation constraint that you want to show up and buy at all? And incentive constraint for the normal customer says the normal customer would rather buy what you offer them rather than the other product. That the fanatic would be willing to buy what you offer them rather than the other product. But what did we say just now? That the incentive constraint only binds for which one? The fanatic. Incentive constraint. So we know that the normal customer's incentive constraint, that constraint doesn't bind. So it doesn't determine the solution. That constraint binds. And who's being held to 0 rents? Which customer? Normal. So theirs is the one where the participation constraint, the individual rationality constraint binds. So you already know all this stuff. Okay. And we can do a version of this with capital budgeting. So I've got a project that will give me $1, but the cost is equally likely to be 0.5 or 0.8. All projects have positive NPVs, but I have a hurdle rate policy that says I'll only accept your project if it's equally likely that costs are 0.5 or 0.8. What can you do? You can accept all projects, in which case you'll get 1 minus 0.8, because you'll have to pay 0.8 because in the Antelope model, the agent consumes the slack, consumes the difference between what you pay them and what the actual cost is. Again, risk neutral. Okay, so again, I usually use Coke as an example. I want a Coke, but I've stopped drinking Coke. I want a bottle of water, and it's worth $1 to me, but it costs 50 or 80 cents. And it's equally likely to cost 50 or 80 cents. You offer to go buy the bottle of water for me, but you're selfish and will consume any extra money I give you. And so the possibility is I give you either 80 cents and I say, keep the change. If it's 50 cents, don't bring me any change. I'm being generous, giving you that 30 cents. Or I can tell you, come back and give me the bottle of water, or give me my money back and give you 50 cents, right? I can be a cheapskate. And so the cheapskate is valuable when? If it's very likely the cost is 50 cents. So if it's equally likely, I'm better off, in fact, being the cheapskate, right? Because with then probability of half, I get a utility of $1 minus 50 or 25 cents. Whereas if I was told you to keep the change, I would instead get, with probability 1, $1 minus 0.8 or 20 cents. So what is that saying? I ration production away from the bad type, the high cost, in order to save rents to the high type, the low cost. So the same kind of model. I've got my own bottles of water. Okay, so we can write this out. It's the same kind of problem. There's a little bit more here in terms of other constraints. What am I doing? Well, it's linear production. So it's not a bottle of water, it's a number of bottles of water, any amount of water. And so we're assuming the maximal amount of water is X, right? What does that do? It gives you a solution, because otherwise you'd have, be end up producing an infinite amount of water. So you get an output feasibility constraint in the Antelope problem, and then everything has to be non-negative, all the production levels and transfers. And in general, with the linear structure, no matter how many costs there are, what you get is a cutoff. And so at that cutoff, you pay that amount to all costs below that, and you shut down for all costs above. And how's it related to capital budgeting? Basically what you're doing is throwing away some positive NPV projects to save rents to the agents. I think a realistic assumption here that's not in the model, and I think Tim may have done something related to this, but the idea that information asymmetry is greater for projects that have longer returns, so you would be tougher on those. I think the idea that, say, internal rate of return is tough on projects that have cash flows way out in the future would be sort of an interesting thing to try to model. Basically, information asymmetries are greater for projects that have cash flows further out in the future. Okay, so that's the risk-neutral version solved for anybody that wants to know how to do the math, but we're not going to do it here. I'm glad to answer questions after the break, but it's written out. And there's a little bit of laziness here. Instead of writing it out in my writing, I did it in Mathematica for you. And I think I stop here. All right, we started a little late, but if I stop at 10:30 and then we get back on schedule, so we've got, 10:45 start time? Is that the next session?
Do IID projects.
They both have a cost that's equally likely to be 50 or 80. And the agent comes to me with both of these projects. Am I going to treat them independently or am I going to intertwine them? So again, when I had a single project, what did I do? I said to the agent, I'll only take your project if the cost is 50. Because with the probability of half, I got 1 minus 50 or a quarter. Whereas if I took the project with the cost of 80, I would only get 20. So I rationed, right? I threw away a good project to get an even better one with less rents. Okay, the rationings of the bad type, the high cost. So now I've got an agent that shows up with 2 projects. And the constraint again is I've got to provide all the funding for it. The question is just where I draw the cutoff. So I could say they both have to be good projects, right? Which would be what? I would get, with probability a quarter, I would get 1 minus 50 times 2. Right? So I would get, what would we say, a quarter of 50 cents. No, quarter of $1. So I get 0.25, right? Out of 2 of these projects. Or I could say, I'll take them all, right? I'll take them all. So with probability 1, I would get these, I'd have to take a total of 160. And I get $2. So I get 40 cents, right? So with probability 1, I get 40 cents. So what do we say? We had one that gave us 50 cents, one that gave us 40 cents. So we're looking for something that does better. So what if I say to the agent, I'll take your project if and only if the cost is 50 and 80, 130 or less. Okay, so what will that give me? So if the cost for both projects is 80, it'll get rejected. But if the cost is 130 or less, it'll get accepted. And how often will that happen? So I'll pay 130, I'll get 70 cents. $2 minus $1.30, I'll get 70 cents. How often will it happen? 3/4 of the time, right? Because they're IID. So 3/4 of the time, the cost will either be 50 and 50, 50 and 80, or 80 and 50. So 3/4 of the time, I'll accept it. The cost will be, what did we say? The revenue's 2, cost is 130, so I get 70 cents. So 3/4 of the time, I get 70 cents. That's 210 divided by 4. What's 210 divided by 4? More than 50. Right, so I did better. Right, I did better by bundling these together. So another version of this is what you see in capital budgeting is often capital budgeting decisions are made in a particular period of time, like once a quarter, or once every 6 months, or once a year. So you don't have agents come in, you don't have managers come in and say, I've got a project, will you take it or not? Often there's a meeting, right? And you do that periodically within the organization. So this is a reason that you might want to wait and group them together, right? Have the projects all evaluated at the same time, launch them together. What's the intuition though? Why is it better to bundle them than treat them independently? After all, they're IID. Why is it, the solution with one project was just take it if and only if the cost were 50. Why wasn't the solution the same thing on 2 projects? Treat them independently. Why did we do better by coming up with this solution where they're lumped together and you only take them if one is 50 and one is 80? So what's the distribution look like for a single project in my example? Equally likely, right? What's the distribution look like when there are 2 projects? Quarter, half, that is 50 plus 80. And a quarter. So it's a more concentrated distribution. Right? So if you take, multiple projects that have the same distribution and put them together and you get this more concentrated distribution, one way to think of it is that there's less of an information asymmetry. It's a little too rough, Jeremy. But the idea is that there's less of an information asymmetry between the principal and the agent. And so the principal does better because the principal has a better idea of what's more likely. Right, obviously in the extreme, if you had a really concentrated distribution, that's going to be a lot better than a diffuse distribution for the principal. So this is giving you a little bit of that, right, by pulling the projects together. Now, projects have different distributions, so imagine one project that's very likely to be 50. What's going to be the optimal contract for that one? Well, only take it only if the cost is 50, right? And so the other project is very likely to be 80. I'll take that one no matter what, pay 80, right? And then if you put them together, that's not going to hurt you. You end up with a distribution that isn't more concentrated. You end up with one that's more diffuse when you put them together. So it depends on, when you put them together, what happens to the distribution, whether this creates that advantage that I'm talking about. It's when you get the more concentrated distribution. Okay, so I've worked this out for you with more types. And so again, you want to think in terms of, the highest type, what you do for them, the best type doesn't create rents for anyone else. So it's only the lower types. So if the best type is T, capital T, for type T minus 1, who does that production create rents for? Just T. Whereas for type T minus 2, who do they create rents for? Both T minus 1 and T. So the further down you go in terms of lower types, the more rents you're creating for types above you. So you end up with more severe rationing at the lower end than you do at the higher end. Yeah.
Sorry, I think I missed it in the setup for the prior problem, but is the principal handing the agent one lump sum amount of cash and then the agent allocates it, or is the principal saying these are the projects that you must take on?
The constraint on resources is that you have to provide enough funding to cover any cost of production undertaken. But the agent can decide where to put it, which projects. So if one costs 50 and one costs 80, to get the 130, the agent will figure out where to put them. If they both cost 50, the agent will just pocket the extra 30. Anyway, just trying to argue that bundling can make sense, right? So they make this argument about Office. You know that some customers like Excel, other customers like Word more, but the bundle creates less of an information asymmetry overall about what the customer likes. So there can be an advantage to bundling from the perspective of information rents, that you have less information asymmetry between the principal and the agent when it comes to the bundle of the product than it does to the individual products. So you end up with that kind of story sometimes being argued for why you see bundling in practice. Non-linear production, so just to get a model where the agent is, I did the risk versation, I did still risk neutral agent, but non-linear production, the cost of production is convex. What's going to change? Basically, for the worst type, you don't go down to 0. You still produce, but you limit their production in a way to save rents for the higher type. So I think I've got a picture, but unfortunately it's me drawing out a picture. So it's, what are the lines represent? The utility to the agent under the high type, which is the low cost. So that's the better agent, the lower cost. And that's what you'd have to pay in. T is the transfer. So to get the same utility level for any production level, you've got to pay more to the high cost agent than the low cost agent. And so if you solved it and say you got first best production levels of this and this, if you try implementing it, the problem is the good type would say, no, I'm a bad type, because it lies, if you draw a parallel utility curve for the CL type agent and it goes through that point, right, it's going to give the agent rents. So they would lie and get up to that higher utility curve and earn rents. And so what you end up doing is pushing down production for the bad type to limit the rents that the good type end up earning. These blue dotted lines represent the rents that the good type, the low cost, ends up getting. So by pushing down that production, I get closer and closer to 0 rents. So first, how could I get 0 rents for the good type, the low cost agent? Just produce nothing for the bad cost agent, right? And we end up with, in the nonlinear model, is an interior solution where you produce something for the bad type, but more for the good type. And as you'd expect, what happens if it's very likely you're a good type, then what do? Produce almost nothing for the bad type. because the lost production doesn't cost you much. If you're very likely to be the bad type, what do? You produce closer to the first best level for the bad type, and you pay a lot of rents to the good type, but with a small probability. Right? And again, it worked out for you in terms of solving it. And more types, and so here a complication that can arise is you need to have a condition satisfied to make sure your production is monotonic. So what you'd like to do is be able to just look at adjacent constraints again to say that you only worry about high cost pretending to be medium, that's binding, and medium might pretend to be low, that's binding, but you don't have to worry about high pretending to be low. And so you need monotonic production. You need it to be true that the lowest cost has the highest production, medium has the next highest production, and so on. And so you need some assumption, namely this condition. I take a long time to get to it. Monotone hazard rate condition that ensures that production is monotonic. Okay, so if you see monotone hazard rate, they're trying to make sure that, again, it's about making sure that the adjacent constraints are the only ones you have to consider, which works out nicely if you've got monotonic production. So you need a condition like that to get monotonic production. Okay, multiple agents. I don't want to say much about this, other than even in a one-shot game, you can have multiple equilibria. So you can end up with equilibria where if the other agent's reporting the truth about their type, you're willing to tell the truth too. You'd both be better off by reporting that your type is, say, hot. Okay? Or cost is hot. Your type is bad. So you could end up, with an equilibrium where you both lie, and it could be a Nash equilibrium in a one-shot game. And then what people have done in the implementation theory literature is they've tried to add messages, additional messages, to get rid of those multiple equilibria. Okay, so what implementation theory is about is you have some kind of desirable allocation you're trying to achieve. And the question is, what do you want to achieve it as? Do you want to achieve it as a Nash equilibrium? Do you want to achieve it as a unique Nash equilibrium? But there's basically a notion of designing a mechanism, which is a message space and an outcome function. In our world, a message space and a contract. And make sure that what you get is what you want to get out of the mechanism. And you can think of auctions as that kind of problem. Right? You can think of incentive theory, the moral hazard example is that. But basically, you're designing the mechanism. And designing the message space starts to sound a little bit more like accounting, right? But the message space and an outcome function that gets you the equilibrium that you want. And so if you've got multiple equilibrium under the basic game where you ask the agents to report their types, what the literature does is what if I add extra messages to get rid of the multiple equilibrium? So the typical approach that was used was kind of a ratting game. So you would say the other agent is lying. The other agent is reporting his cost is high more often than the distribution suggests. And you would offer a lottery to the agent who was ratting that would make that appealing if and only if you thought the agent was ratting. And this is where actually Jeremy's economics letters papers comes into mind. I don't like the ratting mechanisms. I don't like them because you could have a man on the moon doing the ratting, because you don't have to see anything. It's just your conjecture of what the other agent is doing. Right? Under Nash equilibrium, it's common knowledge that you're playing the equilibrium. So you could have somebody that has nothing to do with the other agent conjecturing. But Jeremy actually, I think, liked those mechanisms and said, well, in the labor market, in a labor market, you could have sort of that thinking going in to help sort things out in the labor market. That you think that there's some collusive strategy being played which makes you willing to take the job for a lower fee or something like that. Basically, you use that kind of ratting approach. It's been a long time for me, but anyway, you use that kind of ratting approach to sort out things in the labor market. Was his idea in the economics letters paper, something along those lines. You're conjecturing something about collusive behavior in the labor market that could create additional rents, could make it more appealing, and your willingness to go into that and get rid of the rents. In any event, at least the papers I remember better than Jeremy's. I'm predicting that you're doing something bad, And then they often do something where they don't close the loop. They say, let's create an open interval of reporting so that I want to turn you in. But given that I want to turn you in, I don't have a best response. I can always report a little bit better. And so they say, oh, they won't play that because there's no equilibrium there. That's like saying, I give you a game where I say, write down on a piece of paper the biggest number you can write down. And you also write down the biggest number you can write down. And whoever writes down the bigger number, I'm going to give $1,000 to. And if it's a tie, you don't get anything. And you say, well, there's no equilibrium. Or if either of you write 0 down, that stops the game, you get nothing. All right, and what's the Nash equilibrium of that game? Well, you say, if you have an infinite amount of paper and an infinite amount of ink, there's no equilibrium because if you write down a billion, she writes down a trillion, and you keep going, right? But what is an equilibrium? If she writes 0 down, you're willing to write 0 down too, because 0 shuts it off, nobody gets anything. And so you argue in that kind of game that, oh, they're going to both write down 0 on the paper. Do you believe that for a second, that they're going to write 0 down? Maybe $1,000 isn't big enough, but if it were $1 million, they'd be busy writing. They wouldn't each write 0 down. And so that kind of took game theory in a way, and the Nash equilibrium solution concept. I don't know if you say too seriously, but basically they tried to exploit the weakness of the solution concept. Right? They tried to design mechanisms that gave you a unique equilibrium by designing funny games. Right? Funny games. I'm not saying Jeremy's game was funny because his was not. His work. But this sense of, you sort of just wanted to know, it's like an existence result. Can you get rid of that equilibrium without creating new equilibrium? And you could do it. The mechanisms didn't look that intuitive. So what I did in my dissertation is I looked at a different approach. I said, let's not try to exactly get the second best. Let's just try to get arbitrarily close. Well, let's try to do it with confession. So I don't brag on you. I just tell the principal, I know I said my type was, my cost was high, but it isn't. My cost is really low. I lied to you. And I can prove it because I'll produce a little bit more, and I'll do it with extra wages that I would want to do if and only if my cost is really low. So I'll prove to you that I'm lying. And of course, the principal up front has all this power of commitment, right? And the principal commits not to hold your lying against you, but rather to use it against the other agent. So if you admit to lying, then we go after the other agent and use a horsing contract that makes them tell the truth. Basically, when you're playing this game, you say either the other agent is telling the truth, in which case I know my best response is to tell the truth, or I know he's lying, but then he admits to lying to the principal, in which case the principal's going to offer me a forcing contract where I want to report the truth. So either way, I'm stuck. I don't report the truth. Because if the other agent is telling the truth, I want to report the truth. And if he's lying, he's going to confess to it, and then I'm also going to be facing a contract off equilibrium where I want to report the truth. So to me, confession seemed tighter. Seems like a neater way to get rid of these problems. But of course you see both things. We see bragging, we see confession. In the end, I think we're still taking mechanism design too seriously. Contracts too seriously. Because you've got all this commitment, right? You've got all this commitment. Which leads me to the next topic. So let's talk a little bit about limited commitment, and then we'll switch gears. So Xiao was once giving, I think, a conference in honor of, you were there probably, were you there, Monica, at the conference in honor of John Dickow that was held at Chapman, that's right. And Xiao said, talking about transparency, he said, who wants to live in a glass house? Well, it depends on the glass house. There's some really pretty glass houses. This is Philip Johnson's glass house in upstate, I think it's in Connecticut, actually, maybe not upstate New York. But of course, it helps that you don't have any neighbors. So, first question. In the analytic kind of model, is the agent always worse off if the principal has better information? Okay, so let's think about an example. Let's suppose that the principal only knows the costs are equally likely to be 10, 20, or 10, 70, or 80. Why did I pick the 10? Because it's profitable enough that the principal will ration and only accept projects. You'll get a third of 90, which is 30, which is better than any of the other cutoffs. So you're better off saying, I'll only take the project if the cost is 1. Now suppose the principal knows that the cost is finer information. The principal knows either that the cost is C1, so the principal knows that for sure, or he knows it's equally likely to be C2 or C3. What will the principal do when the cost is C1? Okay, C1. What will the principal do when the cost is C2 or C3? Well, you could say I'll produce for sure and get 20, or you could say I'll ration and get 30 with probability half, which is 15. You won't do that, right? So instead, it'll produce for sure. What is the agent's rent now? Well, under the second information structure, when the cost is 70, the agent gets a rent of 10 because he's offered a contract that says that he'll produce and pay 80 no matter what. So now the agent earns some rent. So actually, the fact that the principal has better information helps the agent. It doesn't hurt the agent. Okay, so there's no result that says just because the principal has better information, the agent's going to earn more rents. So another way to say it is, it's not just about the split of the pie, it's also about the size of the pie. And the information structure affected the size of the pie in this case, which gave the agents a bigger, gave them more in the end. So that's saying something like, if you had an information system that advantaged your boss, you wouldn't necessarily sabotage it. It might actually be good for you. And then let's ask the real question I want to ask here, which is more information always good for the principal, not the agent? Is the principal always better off with more information? And so typically we talk about information being used for decision problems or control problems, but the two can interact. Okay, so the problem, I'm actually not going to go through the numbers, I'll just tell you the intuitions. I want to get on to the next topic. But the intuition is, I suppose I've got a principal-agent model where the principal designs a contract, the agent acts, and then the principal decides whether or not to intervene. And by intervene, I mean the principal can put in effort to help make things better. Okay? And the question is, do you want the principal to have information that gives her the ability to figure out whether to intervene or not? Well, from an ex-post perspective, surely you'd like to have it, right? Because it's a decision problem at that standpoint. The agent's effort's already sunk. You'd like to have information to figure out how to intervene. Also, from the agency problem, the information can only help because you have another performance measure you could use to condition the agent's payout. So if you think about the decision problem, the principal's action, or the agency problem by themselves, either way you get the result that you'd like to have the information. But the two interact with each other. So imagine that if the principal comes in and bails the agent out, that the agent's effort matters less. Right? So what's that going to do to the problem? If the agent anticipates that they'll be bailed out, then it's harder to motivate the agent to work in the first place, right? So you might want to commit not to have that information to commit to avoiding to bail the agent out. And it turns out it's going to depend on the nature of the production function. In the model we look at, if the principals of the agent's actions are complements, strategic complements, you're going to want the information. If they're substitutes, you're not going to want the information. But I'm not saying it always goes that way, but that's the way it works in the model. And basically, the principal working making the agent more productive is going to make it easier to motivate the agent. But if the principal coming in and bailing the agent out makes the agent's effort matter less, then the bailout's going to interfere with motivating the agent in the first place. So that's the basic result of that thing. Yeah.
I just want to basic information was better for the social welfare perspective and kind of things like that.
The answer is no, because you can get the result that you don't want the information even in risk-neutral models where the agent's held, or even in risk-averse agent models where the agent is held to his reservation wage. Right? I'm not saying that model, but I'm saying in general, I can give you a principal-agent model where the agent's risk-averse, the agent's always held to the reservation wage. So the principal's better off not having the information. And here's a sort of classic example in game theory. I think it's in Stan Baeman's paper from 1975, which was probably his dissertation paper. It basically says, you know, I might not want to have the information because it's a way to commit to act in a certain way. So basically, not having the information is a substitute for commitment. I'll let you look at this for yourself and work through it. But basically what happens is that, you know, if you don't have information, you can get to a nice equilibrium in the game. Right, so what is it? It's the equilibrium where you both end up getting 2. Whereas if the second player, the column player, has information about the state, whether you're in this game or this game, then he'll get pulled away from 2 to 3 here. You'll get pulled away from 2 to 3 here, and you'll end up at an equilibrium in either of these games. Is this an equilibrium? I think so, right? You'll end up with an equilibrium that only gives them 1 if the second player has the information, whereas if the second player, the column player, doesn't have the information, they can get to the equilibrium where they both get 2. What's the advantage of not having the information? You can commit to act in a certain way that wouldn't be credible if you have the information. So information system design can be a substitute for commitment, or commitment to play in a certain way. Kramer, I'll tell you the basic story quickly. The idea is, let's just forget about math. There's not much math, but let's forget it. It's very easy to tell. So imagine that you've got an agent who doesn't know their type. Now there's an ability, which is something you were asking me about before, right? That you're better fit with the firm or a worse fit. And when you hire somebody, they're equally likely to be a good or a bad fit. But when you see the outcome at the end of the first period, you're going to learn something. Namely, if the outcome is a success, well, then it's more likely you're going to update, and it's more likely the agent is a good fit. If the outcome is a failure, it's more likely the agent is a bad fit. And so if you don't know the fit, you just know from the outcome, you learn about fit from the outcome, what are you going to do when the outcome's bad? Let's go to the labor market again and try to find a new manager, and hopefully we get, you know, because this one's more likely to be bad type. At least we have a 50-50 chance in the new market. That actually has good incentive properties in terms of motivating the agent if he earns rents in the malls, or maybe there's a cost of job search. Because now he says, I want to work. Why? Because I get paid bonus. And I want to work because I want to keep my job. I want the principal to think I'm the good type, but I want to be kept. Because if I get fired, maybe I'm going to have to engage in a job search, maybe I'm going to be unemployed for a period. So I work for 2 reasons, which means the bonus can be smaller. Now imagine the principal actually knows at the end of the first period the agent's type. He learns whether he's a good fit or a bad fit. Now what's going to happen? If the outcome is low and you learn the agent's a bad type, you'll fire him. That'll still happen. But if the outcome's low and you learn the agent's a good fit, you're not going to fire the agent because he's better than what you could get in the replacement market. Right? So now you can't, you know, you're going to be stuck retaining agents even when they have a bad outcome if you learn that they're a good fit with the company. That's going to make it more expensive to motivate the agent in the first place. Does that make sense? It's more expensive to motivate him because you won't end up firing him when the outcome is bad. If you learn his type is good. So again, more information is bad. You'd be better off not knowing that there's a trade-off. So it's not that you're always better off. But basically from the perspective of if you want to be able to fire him when the outcome is bad, the way to do that is not to know what his type is at the end of the first period. You don't want to learn his type. You want to update only from the outcome. Yes?
But won't you still be able to assign from the culture, you observe the outcome that the agent is still a good type, even though you don't know for sure whether it's a good type?
I don't think I understand the question. So
like, even though you don't know for sure whether the manager is a high type or low type, you still are able to assign some from the
yes, you update. So the point is that when you update, it works well because what that does is it makes you want to fire him when the outcome is bad. So now not only does he not get a bonus when the outcome is bad, he gets fired. And if firing is in some way costly, you can think of that as relaxing the bankruptcy constraint. So before, like in our problem where we had to pay a bonus of 5 and he got 0 if he didn't work, Suppose he gets a disutility of 2 for being unemployed. Then now effectively the bankruptcy constraint isn't 0 anymore, it's -2. So that means your bonus only has to be 3. So it relaxes your incentive constraint in terms of the bonus you have to pay because of the firing. Okay? And that works if you don't learn his type. Because then what happens is when it's a bad outcome, you'll fire him because you do exactly what you said. You update it because it's more likely his type is bad. But if you learn his type, even if the outcome's bad, you're going to keep him. So basically the firing decision will no longer depend on the outcome, it will only depend on what you learn about his type. And so that was my model about intervention and bailouts, which gets you this result on the complementarity. Basically, when you've got complements, you want the information. If you don't have complements, you might not want the information. So it's just, what we call double moral hazard. There's moral hazard on the agent's part, and then the principal also has moral hazard because they're also contributing effort. The other kinds of moral hazard problem for the principal, that's one. And then this one is really simple. It's just saying that if the principal can't commit to a ration in the Hamilton model, if you pool some negative NPV projects with the ones that are just slightly positive NPV and you have course reporting, that's a way to credibly commit to rejecting positive NPV projects. Basically, you don't let the agent tell you exactly the NPV. You just report it in an interval, and you make sure that there are enough bad ones in there that you'll end up rejecting wherever you want to reject. So you can basically want course communication from the agent about the project to be able to commit to rejecting some projects. And this one I like a lot, but unfortunately I didn't into all these in terms of the real insight. So in this one we looked at Hamilton with project search. So the idea is that the rents that you earn later motivate the agent to engage in search to identify good projects, low-cost projects. And so in that world, we looked at an information system design along a number of dimensions. One was course versus fine. The other was self-reported versus monitored. And the other was early versus late. And you found that you could use those different ingredients to, it'd be better to have course information, it'd be better to have self-reported information, it could be better to have late information as a way of getting the agent to put effort in to find a project, right? If you know that the minute I find something good, you're going to extract all the rents, why do I waste my time putting effort in finding a good project, right? And I have to have some rents to motivate me to search for a good project in the first place. And Aggie and Terrell's model is it's not just a nice model, but it's also very, very nicely described in terms of, whether you want authority. Do you want the principal or the agent to have the authority, and they make the distinction between real authority and what they call nominal authority, formal and real authority. The idea that, again, you want to give the agent enough authority that they want to engage in the search to identify good projects in the first place. Okay, finally, I'll just talk briefly about the revelation principle in earnings management, which I get a lot of flack for. It's my most cited paper, but also probably most controversial, which is basically to say the following. What does the revelation principle tell us? Well, in the analytic model, I could tell you, here's 80 cents, bring me back a bottle of water, and give me my change back if there's change. Right? But the model assumes that if I do that and the cost turns out to be 50 cents, you'll lie. And you'll say, no, the cost wasn't 50 cents, it was 80 cents, and you'll keep the change. But the revelation principle says I can always reformulate any mechanism of any game. I can reformulate any equilibrium of any game that arises under any mechanism as one under which you have the agents reporting their types and they'll tell you the truth. So go back to what happened. So I tell you, bring me the change, and you don't. What's the equivalent mechanism? Here's 80 cents, keep the change. So I don't put you in the position to lie. Basically, I tell you, no matter what you tell me, if you tell me it's 50 or 80, I'm going to give you 80 cents. So I can I can get the same outcomes by just relabeling the one you lie and giving you whatever you would pocket, committing to give you that anyway, but letting you tell, motivating you to tell the truth. So what the revelation principle does for us is it really helps us solve problems. The main purpose and the reason it was designed in the first place by Meyerson and others was to help simplify the problem. So that when you write down the objective function of the problem, you can write in as if the agent is telling you the truth. You don't have to imagine that the agent is doing some very complicated line and plug that into the objective function. And then you write down constraints that ensure that the agent wants to tell you the truth. And you know that's without loss of generality because the revelation principle says whatever you can achieve with any mechanism at all, you can also achieve with a mechanism that motivates the agent to tell the truth. So it's just a way to simplify the problem and solve it. Okay? But what I want to do is then turn the revelation principle on its head exactly, but use it differently. So in the most general version of the revelation principle, you can have a principal who has limited ability to commit. You can have all of those things, but then you can't have the principal be the designer. You can't have the principal handle, in particular, the communication. So if I've got a problem like my principal that would bail the agent out, the revelation principle doesn't say that the principal can design a contract where the principal gets the communication and you get an optimal solution. It says you can design a mechanism where you bring in a disinterested mediator to handle the communication. And the mediator then communicates back to everyone. So it's as if we have a computer, effectively, and we don't talk to each other in this room. What we do is we send messages to the computer, and the computer then sends back messages in a way that would get us back to the same equilibrium. And the computer commits, because the computer doesn't care about us. The computer will do whatever it's programmed to do. So the computer is programmed in a way that it's incentive compatible for you to tell the computer the truth. So you may be all sitting here thinking, this is really boring, I wish I weren't here, I'm tired, I want to go to the beach, whatever else. And what you really would tell me is, the lectures are great, they're so stimulating, and I can't wait to have more time to look through the notes carefully. But we let the computer do that, right? You write to the computer how much you'd rather be at the beach. What does the computer send me back? They really like it. They're very happy. They want more. The computer replicates what would really go on in the environment. But it does it in a way that makes it incentive compatible for you to tell the truth. It doesn't mean I can write such a mechanism standing. It doesn't mean I can tell you, as say I'm the principal, which is a little bit of a stretch, but more like Jeremy's the principal, I'm the agent. But the point is, I can't do that. It's not about principal writing it. It's about there being some way to formulate it in an abstract way. So the more complicated the problem, the revelation principle starts to sound like kind of a not so useful thing to solve the problem. Right? It's kind of hard to really write down a way for the computer to do this in a way that sort of gets us back to something practical that helps us solve a problem, the more complicated the problem. In concept, it works, but it sounds really messy to try to formulate it once we get to that level. Yes?
So what about that 30 cents? If you say just keep the change, but you really wanted the 30 cents back, the idea you just want the 30 cents.
It's not that you want truth. It's just saying that from the perspective, that's an important misconception about the revelation principle. The revelation principle doesn't say anything about wanting the truth. It just says you can solve the problem designing the problem as if the agents report their private information and they report truthfully. It doesn't say anybody cares about the truth. Okay, so it's just, again, a trick to solve the problem. Okay, so now I want to say, let's suppose that we think about the principal actually being the one that has to make the commitment. So let's get rid of this disinterested mediator. And let's think about why lying occurs. Why does something like earnings management happen in reporting? One reason is the principal has limited commitment. The principal can't commit to ignore what you tell them. They can't commit that if you tell them what earnings are low that they're not going to get fired. You can't commit to that. So limited commitment is one reason. Another reason, and so the limited commitment story in our paper talks about, basically I want to attract good talent, and they know they're going to get fired relatively quickly. It can be difficult, it can be expensive at least to attract good talent. And so I might want to commit to giving them a little bit more slack, and I can do that by allowing them manage earnings in the short run. So that some opacity in the system can be a way to attract better employees. And there also can be a sort of bailout story. And to get people to work hard, I have to commit to not intervening too much. It can't be a board that's constantly looking over their shoulders and telling them what to do. So earnings management can facilitate that kind of opacity that makes it attractive to come and work someplace. It also makes you want to solve problems because you know somebody else isn't going to look over your shoulder and tell you what to do all the time. Okay, so that's one kind of story. Another set of story, and that's the one that's our story in the paper. Another set of stories relies on block communication. So the revelation principle says you have enough bandwidth to report your private information. So the story that Joel Dembski wrote that I like very much says that, suppose if you work hard, you can see into the future better. And then you smooth earnings. What does smoothing earnings do? Well, if you can pull over 2 periods that things have to add up to the truth. But if you work hard in the first period, you have a better view of the second period. Who's going to be better at smoothing earnings? Managers that work hard because they know more what second period earnings are, so they know how to smooth better. Right? So smoothing helps convey earnings convey something about performance, but smoothing conveys also something about how hard you work. Because if you can smooth well, it means you work well because you can see the future. Where's the block communication there? So that one's not about limited commitment, it's about block communication. Let's do a flight version. You get on a plane. The flight is smooth. You say, does that pilot seem to know what they're doing? You sort of, you're by the smoothness, you're conveyed that the pilot knows what he's doing. What's another mechanism the pilot could use to convey his expertise? They talk to you. You get on the intercom and say, there's a rough patch coming up, there's going to be some turbulence. Or now I'm going to take you for a loop-de-loop. Get ready for it. Here it comes. So basically there's block communication in the Dembski story. Because if the manager could say, I worked hard and I know next period earnings are going to be high, because I can see into the future, because when I work hard in a crystal ball, that would work too. You wouldn't have to do any smoothing. You could just forecast. So basically he's not allowing you to forecast next period's earnings. He's saying you can only do it through smoothing. Not a realistic assumption, right? So you could dismiss the theory on the basis of realism, but I still think actually a very compelling one. That somehow, managers who are either inherently talented or work hard have a better ability to manage the earnings process, right? And that could be potentially beneficial. You can signal something about your expertise or your acquired expertise through work, through your ability to smooth earnings. Right.
I know you have 4 questions.
Because of what? Okay, so that's adding another, we're going back to the limited commitment. Yeah. So if you added that, then you can imagine that the two together would give you a similar result, indeed. And then the final assumption is about contract forms. So you can have results where, actually, Philippe Mukherjee wrote a very nice paper that does the same thing, but he talks about decentralization. So what's the revelation principle look like? A very centralized world, right? Everything gets reported up to the principal, and the principal tells everybody what to do. And Philippe says, well, if you've got block communication, you could have a strict value to decentralize it. If you've got a limited commitment, you could have a strict value to decentralization. Okay, but another assumption is the contract form. So the contract form, if you had, say, linear contracts, then you could introduce a value to income shifting as a way of effectively introducing a nonlinear rate. Suppose you had restricted the model to be one where you said contracts are assumed to be linear, which we sometimes do in compensation models. But it turned out actually they weren't optimal. Well, if you could have different slopes in the different periods, then by shifting income across periods, you could end up effectively mimicking a nonlinear contract, not getting closer to something that's nonlinear by shifting income in the direction that is offered. If the slope is steeper in the second period and you want a convex compensation contract, then shifting to income in the second period can give you that convexity because the second period has a steeper slope. So restricting the contract form to something like a linear contract is also a limitation that violates the revelation principle. So why do people complain about it? Because they're thinking of that disinterested mediator, the computer in the closet. They're saying, you could always take your problem where the agent lies and reformulate it by reintroducing that computer, and then we get back to truth telling. But I'm not trying to solve the problem. I'm trying to give you this classification scheme, kind of like Miller-Modigliani, where I say, here are some assumptions where you would not get earnings management. And so if you want earnings management in a model, it's got to violate one of those assumptions. Just like in the Miller-Modigliani model, you've got to have a violation of one of your assumptions before dividend policy matters. That's the intent.